Welcome to Bendigo Bank's market update for May, with our latest insights and forecasts for global markets and the domestic economy. This month we'll have a look at the latest RBA policy decision, delivering another rate hike, recent key data for jobs and consumer sentiment, and the ongoing developments in the Middle East conflict, with their implications for our economy this year. The third RBA policy meeting for 2026 delivered the third successive rate hike, taking us back to 4.35% and unwinding all of last year's easing cycle. As we noted last month, this is a remarkable U-turn from just 6 months ago. However, it has been clearly exacerbated by the Middle East war, which landed on top of inflationary pressures that had already emerged ahead of the energy crisis. This pace of tightening has run much faster than our more conservative forecasts from earlier in the year. Time will tell if this aggressive approach is rewarded by containing inflation more quickly without pushing the economy into recession, versus a slower pace that would have protected more jobs but required more tolerance for inflation. Even so, the market still expects another hike to 4.6% later in the year, matching our forecasts we've shared on our Business Insights website since February, albeit at a faster pace than we had expected. This also matches recent comments from the RBA that they expect inflation to stay above target for longer than previously expected, and that increased fuel prices risk spilling over to broader price pressures. So the blunt tool of monetary policy is being brandished with the aim of reducing demand in a period of much slower supply, which will slow the economy down further. But consumer sentiment and business confidence had already taken a dive due to the previous 2 hikes and as energy prices suddenly rose. So household consumption and presumably business investment will slow markedly in the coming months. This slowdown in demand, as cost of living pressures re-intensify, will push against the trend of a healthy pace seen at the start of the year. But 3 rate hikes on top of higher petrol costs will be a stern test for our economy. It will also be a test for labour markets, with the unemployment rate still relatively low, around 4.25%. But the RBA are only forecasting an increase from here to no higher than 4.5% over 18 months, a scenario that does seem ambitious. Turning to the global recovery from this downturn, we remain entirely at the mercy of the duration of the Middle East conflict. While financial markets still appear to be assuming a quick resolution, evidenced by fresh record highs for stock markets, the number of ships getting through the Strait of Hormuz is yet to increase. Attempts by US forces to escort ships through the strait have been mixed, and the best benchmark of this success is the price of oil, which is still hoped to peak in the short term to allow a global recovery, but given the uncertainty, a range of scenarios are being contemplated. Our base case forecasts still lean to a recovery in the second half of the year, accelerating into 2027 as tech investment drives the next cycle. But until energy prices normalise, recession risks still remain elevated. Finally, looking ahead to next week, the federal budget will be unveiled. The government faces the incredibly challenging task of supporting households without adding to inflation, while simultaneously needing to improve productivity in our economy, all in a fiscally responsible manner. And that's the market update from Bendigo Bank.